Hi, more revision in less than 15 minutes. Today we're going to explore the balance sheet based on the CSEC syllabus for principles of accounts. Alright, so let's get ourselves going. The clock is ticking. Let's go. The balance sheet is also known as a statement of financial position. In other words, the balance sheet will tell us what is the status of the business relative to the assets that it owns versus the assets that it borrowed from somebody, right? The resources it borrowed from some other entity, including the owner. All right, and the declaration statement should read balance sheet as at whatever is the date that's given, because you want to know the status as at this date. All right, so like the income statement, the balance sheet could also have a vertical style and a horizontal style. For the vertical style, primarily, we mean that we're using 3 columns to the right-hand side. And again, you may also be confused about order, but order is not all that important in the sense that you follow the rules of the balance sheet. That fixed assets should be fixed assets, current assets, right? So for the vertical, for example, we could use this method known as the net asset approach, in which you start off with your non-current assets or fixed assets, as you would normally say. Then you have your current assets minus your current liabilities, which will give you working capital. You can add that onto your non-current assets. Then you can subtract your non-current liabilities, and that will give you your net assets. And all you have to do is to ensure that your net assets equal your net equity. Or you could use the horizontal or more traditional style, which is obviously a layout that uses debits and credits. So the credit side will be where you will place the liabilities and the equity, and the debit side is where you will place your assets. All right, so in that case, you have your equity and your on your right and your non-current assets on your left. Remember, your non-current liabilities will go to the right, along with your current liabilities, and your current assets will be on the right. So in this method, you're basically using the assets equal equity plus liabilities, whereas in the vertical style, you're using assets minus liabilities equal equity. All right? All right, as I said, don't worry too much, even about the order of permanence and liquidity. Don't worry too much about those things. They will fall into place eventually. So let's get a blank page and start our review of the balance sheet. Like the income statement, we're going to use 6 steps. Right, so step number 1, disclose your non-current assets at their book value. So you put in the name of the non-current asset. In the first column of this 3-column approach, you can place the original cost of the asset. In the second column, you could take out all of the depreciation assigned to that asset, and it should give you the book value, which is what you want because the balance sheet is written as at the end of the financial period, whatever that period is, and so that would be the value on the books, right? The book value. So that's step number 1. You put in all those non-current assets and you add them up, and that should give you the section. And so step number 2, disclose the current asset at their book values as well. So again, your current assets is generally a very short list. Inventories, receivable, prepaid expenses, bank cash. That's a generic list. So you look for that. So you put in your inventory. Remember, this inventory is the inventory at the end of the period that you're reviewing. The accounts receivable, remember to take out the provision for that you made, which is the allowance for doubtful debts. You remove that from the accounts receivable because all the provisions applied to the assets must be removed from those assets when you get to the balance sheet. So just as in the non-current assets, you deducted the provision for depreciation that was made, you're going to take away the provision for doubtful debts here from the accounts receivable. where you put in your prepaid expenses. These are assets now because you've already paid for them. You haven't used them as yet. Then there's bank and there's cash. All right. That's step number 2. Now step number 3. Using this method that I'm talking about, you will disclose your current liabilities. And your current liabilities will be anything payable in less than 12 months. So usually you start off with your accounts payable. You can have your accrued expenses, which will be those expenses that are owing and have to be paid shortly. I mean, any other payable items like dividends payable, income payable, stuff like that, right? Tax payable, right? All those can be part of this current liability as long as they're due within the 12-month period. Now, if you have more than one current liability, you will want to use this first column and add them up and bring the answer over to the second column so that it is in line with the current assets. Because step number 4 requires you to work out what is known as working capital. And working capital is simply the current assets minus the current liabilities. So that's all that's step 4. Just your current asset figure minus your current liabilities figure give you the working capital. And that working capital figure is going to be added to your non-current asset figure, right? So you can add this working capital to the total of your non-current assets to get your total assets up to that point in time. And then you go from there, right? See, you're going to add that on. Then you go from there to your next step, which is step 5, which is to disclose your non-current liabilities. So at step 5, you're going to look for all those liabilities for which you have more than a year to pay. You know, things like debentures, mortgage, notes payable, bonds payable, those sort of things. You look for those and you put them in. If you have more than one, use the second column. If it's only one, just go straight over to the end and subtract from the figure, from the total that you have right above it. All right. Now, when you complete that line, you total off that entire section from 1 to 5, and the answer that you get there is the answer that you need to get out for the last step, step number 6, which says find the equity. So in other words, we're saying that the net assets should be equal to the net equity. So the net equity is basically the capital that you started with. You add any new capital that you may have introduced. You deduct any drawings that were made, add any profits that are left over, and that should give you the same answer as step 1 to 5. Now, the reason why you're seeing an asterisk on drawings is because this is referring specifically to a sole tradership. If it was a partnership, those drawings would have been used up in another account, and that other account would be written here. If it's a company, then obviously there will be no drawings, so hence drawings will not be included in that section. All right, so let's do a quick review of this process. So step number 1, putting all on non-current assets. And remember the process, the original cost minus all of the depreciation will give you the book value, and you list all those assets, you can total off and get the total right there. Step number 2 is to find your current assets. So put in all your current assets, right? Register them in the second column, add them up, and keep that answer in that second column. Step number 3, take out your current liabilities. So remember, current liabilities are those debts that are payable in less than 1 year, right? So you're going to subtract those from the current assets to get step number 4, which is your working capital. All right, and you're going to add that working capital to the non-current assets to get the assets, the total assets before the removal of your long-term debt. So step number 5 is obviously the removal of that long-term debt, so less non-current liabilities, and that answer will be your net assets. And therefore, from your net assets now, you want to be able to prove that that is correct by doing your net equity. And your net equity, if you look across the page, is basically your capital, add any new capital, less the drawings, add any retained profits. Basically, add your net profit, in other words. and you should come up with the net equity. Because in a sole tradership, for example, you don't have to share the profits. So all the profits will go into this equity. But if it was a partnership, as I said, then you have to treat it differently, as we will see in another lesson. All right, so that's it for the review of the balance sheet, and I will see you at the next revision.